Section 1. The new rules of the game, more than just tariffs. The quiet but intense economic conflict between the United States and China has entered a new phase, a contest many are now calling Trade War 2.0. This is not simply a rerun of the tariff battles of 2018. While those taxes on imported goods remain a significant factor, the battlefield has expanded dramatically. The central struggle is no longer just about balancing trade deficits or protecting old-line manufacturing. Instead, it is a strategic competition over the foundational technologies of the 21st century: semiconductors, artificial intelligence, green energy, financial architecture. It is a fight for economic dominance and, by extension, global influence. Let us first define our terms for clarity. A trade war is a state of conflict where nations attempt to damage each other's trade, typically by imposing tariffs and other barriers. A tariff is essentially a tax levied on an imported good, making it more expensive for domestic consumers and businesses. The goal is often to encourage the purchase of locally made products. However, the true impact is far more complex. Section 2. Following the money. Who pays the price? To truly understand the dynamics of this trade war, we must follow the money. When a tariff is imposed, the immediate cost is borne by the company importing the goods. For example, a U.S. retailer that brings in furniture from China pays the U.S. government the tariff tax. That company then faces a choice: absorb the cost and accept lower profits, or pass the cost on to consumers in the form of higher prices. Overwhelmingly, economic studies have shown that these costs have been passed on. So, while the U.S. Treasury collected billions in tariff revenue, it was American consumers and businesses who ultimately paid the price. On the other side of the Pacific, the impact was felt differently. Chinese manufacturers faced a sudden drop in orders from their largest market. Some factories had to reduce production, cut wages, lay off workers. To cushion the blow, the Chinese government often allowed its currency, the yuan, to weaken slightly, which makes exports cheaper in dollar terms, partially offsetting the tariff. It also offered tax rebates, other forms of support to affected industries. Section 3. The Great Tech Decoupling. A war fought in silicon. The most critical front in Trade War 2.0 is technology, specifically the battle over semiconductors or chips. These tiny silicon wafers are the brains of the modern world, powering everything from smartphones, cars, advanced data centers that run artificial intelligence. The United States has identified China's ambition to dominate this sector as a long-term strategic threat. As a result, Washington has deployed its most powerful non-military weapon export controls. These rules are designed to cut off China's access not just to the most advanced chips, sophisticated software machinery required to design and manufacture them. The money flow in the chip war is staggering. The U.S. CHIPS and Science Act allocated over $52 billion in direct subsidies to encourage firms like Intel, TSMC, Samsung to build advanced fabrication plants, or fabs, in the United States. These projects, located in states like Arizona, Ohio, represent tens of billions more in private investment. The money goes toward construction ultra-specialized equipment that operates in sterile clean rooms, hiring of thousands of highly skilled engineers and technicians. It is a monumental bet that America can, well, reshore a critical part of the tech supply chain it had long ago outsourced. China's response has been equally massive, driven by a national imperative for technological self-reliance. Beijing is injecting hundreds of billions of dollars into its own semiconductor industry through state funds-directed lending. Section 4. Greener pastures, higher fences. The battle for clean energy. The economic competition has decisively expanded into the green technology sector, a market projected to be worth trillions of dollars in the coming decades. This is a fight over who will build the future of electric vehicles, solar panels, wind turbines. For years, China has executed a deliberate industrial strategy using massive state subsidies. As a result, Chinese companies now control large shares of the global supply chain, batteries, solar cells, producing them at costs Western competitors struggle to match. In response, the United States has enacted the Inflation Reduction Act, the IRA. Nearly $400 billion in tax credits and incentives are dedicated to bolstering domestic green tech production. To get the full EV consumer tax credit, a vehicle must meet strict final assembly rules in North America and source battery components and critical minerals from the U.S. or its free trade partners. This is an attempt to build a non-Chinese clean energy supply chain from the ground up. Money is flowing into new industrial heartlands. Battery giants from South Korea, Japan are partnering with American automakers to build massive gigafactories across the US Midwest, US South. These investments create thousands of construction and manufacturing jobs and revitalize local economies. However, they also raise costs. An American-made EV battery using allied materials will initially be more expensive than one from China's integrated, subsidized ecosystem. Section 5. Rewriting the map, supply chains, on the move. One of the most tangible consequences of the US-China trade war is the great geographic reordering of global supply chains. For decades, the world economy operated on a just-in-time model with China as the undisputed factory of the world. Companies prioritized efficiency and low cost above all else. That era is over. The new mantra is resilience, and just in case geopolitical risk is now a primary factor in every corporate boardroom, and the money is moving accordingly. This has triggered a massive, albeit slow and expensive effort to diversify manufacturing away from China. This strategy is often called China Plus One. It means companies are not necessarily leaving China entirely, but are ensuring they have at least one alternative production base elsewhere to mitigate risk. Two countries have emerged as the biggest winners of this shift: Mexico, Vietnam. Mexico benefits from its proximity to the US and its participation in the USMCA free trade agreement. International firms are flocking to northern Mexico to set up factories, a trend known as nearshoring. This has caused a boom in industrial real estate and logistics in cities like Monterrey, Tijuana, as money pours in to build plants that can serve the American market. Vietnam has also become a manufacturing powerhouse, attracting enormous investment from companies like Apple, Samsung, looking to move parts of their production out of China. Section 6. The view from the ground. People, prices and paychecks. For most people, the high-level geopolitics of a trade war are distant and abstract. The impact is felt much more directly in their daily lives, through prices at the store, choices on the shelf, and opportunities in the job market. When tariffs were first imposed on a wide range of Chinese consumer goods, the effects began to appear on price tags. Bicycles became more expensive. Vacuum cleaners became more expensive. Pet food became more expensive. Importers passed the cost to retailers, who then passed it on to shoppers. This contributed to inflationary pressures, squeezing household budgets that were already tight. The conflict also affects consumer choice. Some brands, unable to absorb higher costs, may reduce the variety of products they offer. Some brands may pull out of certain markets altogether. For small businesses, the disruption has been particularly acute. A small American company built its model around a niche product from one Chinese supplier and suddenly faced an existential threat. They were forced to scramble for new suppliers, often at higher costs, or risk going out of business. These disruptions ripple through the economy in ways that are not always immediately visible. On the other hand, the trade war and the subsequent push for reshoring create new job opportunities. Massive investments in semiconductor fabs in Arizona, electric vehicle battery plants in Michigan, and solar panel factories in Georgia translate directly into well-paying construction and manufacturing jobs. These projects can revitalize entire communities. Section 7. The road ahead. What to watch in a shifting world. As we look to the future, it is clear that this era of strategic competition is not a temporary storm, but a new climate. The US-China economic relationship is being fundamentally reset, and the process is far from over. It is unlikely to end in a grand bargain or a return to the old ways of open engagement. Instead, we can expect a state of persistent managed rivalry, characterized by periods of escalation and de-escalation. The key for observers is to watch the specific pressure points where the conflict is most likely to flare up next, as these will signal the direction of the global economy. First, keep a close eye on tariffs. First, keep a close eye on export controls. Watch for potential new tariffs, especially on strategic goods like Chinese electric vehicles, steel, solar panels, which the US and Europe increasingly view as a threat to their own industries. Even more important are the export controls on technology. Will the US tighten its restrictions on semiconductor equipment? Will China retaliate by further restricting its exports of critical raw materials such as rare earths, gallium, germanium, which are vital for everything from defense technology to green energy? These moves will dictate the rules of the tech and manufacturing race. Second, continue to follow the money, particularly the flow of foreign direct investment. The location of the next wave of major factory announcements will tell us which countries are winning the supply chain realignment. Finally, the ultimate outcome of this competition will be written in Price's Innovation Global Standards, and its next chapter is still being written.